Every year, the market drops 5% or more. Roughly 40% of retail investors sell. Not rebalance, not adjust, panic, liquidate. They lock in the loss, guarantee the worst outcome, and then sit on the sidelines until prices climb back up, at which point they buy back in higher. A JP Morgan study tracked this behavior across 20 years and found that the average retail investor earned a 2.9% annual return, while the S&P 500 returned over 10% per year over the same period. While the long-term average return of the US stock market is roughly 10% per year, most people's average return is less than half of that. A JP Morgan study found that investors averaged a 2.9% annual return. The entire gap, every dollar of it, is explained by behavior, by checking too often, feeling too much, and selling at the exact wrong moment. Meanwhile, there is a specific group of investors who look at the exact same red numbers and feel approximately nothing. The market falls 20% and they don't call their broker. They don't open Reddit. They go for a walk, make dinner, maybe watch something. And the thing separating those two groups is not intelligence, not discipline built over decades, not a better therapist. It's a number, a calculable, specific portfolio size where the math stops working against your psychology and starts working for it. I'm going to give you that number today. More specifically, I'm going to show you there are actually 3 distinct thresholds. Not one why mainstream financial advice is pointing most people at the wrong one, why being at the wrong threshold is actively costing you years of your life, and exactly what to do about it. Morningstar's research suggests that 3.9% is the highest safe starting withdrawal rate for retirees seeking a consistent level of inflation-adjusted spending, assuming a 90% probability of having funds remaining at the end of an assumed 30-year retirement period. And that number changes everything about where you actually need to be, but we'll get to that. Here's what I want you to hold in your mind for the next few minutes. In a few minutes, I'm going to show you the single most dangerous 5-year window in a person's financial life, a window that has bankrupted disciplined savers who did everything right. But first, let me tell you about the most famous and most misunderstood rule in personal finance. Bill Bengen, the financial planner who introduced the 4% rule in the Journal of Financial Planning in 1994, found that retirees could count on their retirement savings lasting at least 3 decades if they started by withdrawing 4% of their money and then increased the dollar amount they're withdrawing each year to keep up with inflation. The strategy caught on because it offered an easy, research-backed way for retirees to gauge how much they could spend without draining their savings. 3 decades later, it's still considered the default for many retirees trying to ensure their money doesn't run out. The shorthand became, save 25 times your annual spending and you're done. Except nobody told you what done actually feels like. And this is where the fishing boat comes in. Imagine you need to cross the Atlantic Ocean. You're in a small fishing boat, 12 meters, single engine, modest fuel tank. You've done the math. You have exactly enough fuel to make it. The engine has been recently serviced. The weather forecast looks acceptable. Statistically, based on historical crossing data, you probably survive. Now tell me honestly, are you relaxed? You're absolutely not relaxed. Every wave is a threat. Every change in wind direction is a data point. You're running fuel calculations in your head every few hours. Because you're at the minimum viable threshold. You are not safe, you are just probably okay. And probably okay is not the psychological state most people imagined when they spent 30 years saving money. This is exactly where the 4% rule leaves people. They hit 25 times expenses, the officially sanctioned you can retire number. And they discover they are still checking their portfolio 3 times a day. They're still losing sleep when the Dow drops 8%. They assume this is a character flaw, that they need to meditate more or worry less or just trust the math. It isn't a character flaw. The math is the problem. At the survival threshold, you are on a fishing boat and the anxiety is completely rational. The ship exists. It's much bigger. The ocean hasn't changed. Only the vessel does. And for the rest of this video, I'm going to show you exactly how large a vessel you need to genuinely stop worrying and the specific calculable steps to get there. Before I get to the 3 levels though, there's a subplot. I want to introduce 2 brothers, both disciplined investors, who hit roughly the same savings target and experienced completely different retirements. I'll come back to them right before the end because the resolution of that story is the most important thing in this video. Hold them in the back of your mind. Now, the 4% rule. The origins of safe withdrawal rates can be traced to William Bengen, who in 1994 analyzed US market data from 1926 and discovered that over any 30-year rolling period, even during the Great Depression, withdrawals of 4% of the initial portfolio, adjusted for inflation, were sufficient to generate lifetime income. Important context. The rule was designed to answer a binary question. Does the money last? Not how do you feel? Not what is your psychological state in year 3 when your portfolio is down 20%? Survivability, that's it. In his new book, published in 2025, Bengen says the safe withdrawal rate is actually closer to 4.7%. However, Morningstar's latest State of Retirement Income report takes a future-focused approach, recommending a more cautious 3.7% withdrawal rate as the sweet spot for a 30-year retirement based on projections for market returns, inflation, and interest rates. So you've got a spread. The most optimistic credible number is 4.7%. The most conservative credible number is 3.7%. And the practical midpoint for most people is around 4%. What does this mean in plain English? It means the difference between probably fine and definitely fine is a few $100,000 in portfolio size, and nobody in the mainstream financial media is telling you which side you're actually on. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. That's $200,000 more than the $1.26 million figure from 2025, and is still a far cry from what most people have socked away in their various retirement accounts. The average retirement savings for all families is $333,940. The median is $87,000. Only 5% of households with retirement accounts have $1 million or more saved. Read that again. The median, $87,000. The number most Americans think they need is $1.46 million. The median is $87,000. The gap between where people are and where they think they need to be is already enormous. But here's the part I want you to actually hear. Where they think they need to be $1.46 million is the survival threshold for someone spending roughly $58,000 a year. It's the fishing boat. And at the fishing boat, the market can still hurt you badly. Stay with me, because the next part changes everything about how you think about retirement math. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. 77%. The 30 years of patient, disciplined investing that got you to retirement, mathematically less important than the decade that immediately follows it. This is sequence of returns risk. And it is the reason some people can retire with exactly the right number and still end up broke. Here's the mechanism. When you sell investments during a downturn to cover living expenses, those shares are gone forever and can't participate in any recovery. During your working years, the order of returns doesn't matter much. A 20% loss followed by a 25% gain produces a similar result as the reverse, because you're not pulling money out. But once withdrawals begin, early losses compound in a way that later gains can't undo. A 20% decline on a $1 million portfolio costs $200,000. The same 20% decline on a $400,000 portfolio costs only $80,000. Same percentage. Vastly different absolute damage. And when you're retired, you're withdrawing on top of that damage, which shrinks the base further, which means the eventual recovery has to start from a lower floor and carry more weight. Sequence of returns risk can cause a retirement portfolio to run out of money, even when long-term average returns are strong. Two retirees with identical starting balances, identical withdrawals, and identical average returns can reach completely different outcomes depending solely on the order their returns arrive. Early losses combined with ongoing withdrawals accelerate depletion in a way that later market recoveries often cannot reverse. Morningstar's 2026 State of Retirement Income research found that retirees who encountered poor returns in the first 5 years and didn't adjust their spending were far more likely to exhaust their savings than those who came through the early years with positive returns. This is the most dangerous trap in retirement planning. You do everything right, you save diligently for 30 years, you hit the number, you quit, and then the market has a bad first year, and you are selling shares to pay rent at the worst possible moment, and those shares never come back. By the way, hit subscribe if you like the content, otherwise the algorithm may never show you my videos again. Now, here's where the story of the two brothers resolves, and also where the CTA lands, because the data I'm about to reference connects directly to something I built for exactly this problem. The updated Trinity data through 2025 still supports the 4% rule for a 30-year retirement with a stock bias allocation. However, Bengen's later research suggests that the original 4% rule may have been conservative. That sounds like good news, but the fine print is the problem. The Trinity study modeled 30-year retirements. If you retire at 55 and live to 88, you need 33 years. If you retire at 50 and live to 90, you need 40. The further you go past 30 years, the more the 4% rule degrades. Knowing these numbers is one thing. Building a system around them is another. I spent a lot of time going through 50 years of actual retirement data, not opinion pieces, actual historical market cycles, actual withdrawal studies, actual behavioral finance research. And I turned it into a book called The Exit Code. It's 8 chapters of analysis, no filler, no hype. The part most relevant to everything I've been talking about today is what I call the dynamic withdrawal method, a replacement for the rigid 4% rule that adjusts your annual withdrawal based on portfolio performance, which dramatically reduces sequence of returns damage in the early years of retirement. The math behind the 4% trap and the reasons it fails people, specifically in the first 5 years, is covered in detail. I also include what I call the 58% rule. About 3 in 5 American workers say their retirement savings are behind where they should be, which maps the real statistical probability that you'll exit the workforce before you planned, creating exactly the forced early retirement scenario where sequence risk becomes catastrophic. The exit code is available through the link in the description. Less than a dinner out for half a century of actual retirement data. Worth it, even if you only read 2 chapters. Now, the 3 levels. Let me give you the full framework with real numbers. Level 1, what I'm calling the survival line. This is the classic 4% rule threshold, 25 times your annual expenses. At this number, the historical data says you probably make it across 30 years. You're on the fishing boat. You're statistically likely to be fine. You are not psychologically calm. Every major correction, and the market has had a greater than 5% drawdown in almost every year since the early 1980s, according to Invesco data, feels like a direct threat. Because at a 4% withdrawal rate, a 30% portfolio decline raises your effective withdrawal rate to 5.7% of your new lower portfolio value. That's outside the safety zone. The boat is taking on water. Historically, the stock market has been positive 3 out of every 4 years. Even on a daily basis, the market is up about 55% of the time, slightly better than a coin flip. But at the survival line, the 25% of down years carry existential weight. They feel disproportionately large, and there's science behind why. Research shows losses feel roughly twice as painful as equivalent gains feel pleasurable, which may make investors prioritize avoiding losses over seeking potential gains. If roughly half of all trading days result in losses, and losses feel twice as painful as gains, it can make investing feel like a losing battle. To the average investor, the market might feel like it's down 2/3 of the time, even though the data tells a much more optimistic story. This was formalized by Kahneman and Tversky in their prospect theory research, which eventually earned Kahneman the Nobel Prize in Economics in 2002. The implication for investors is brutal and simple. At the survival threshold, your brain is running a misleading simulation of reality. The market is probably fine. Your cortisol says otherwise. And cortisol has been responsible for more retirement failures than any bear market in history. Level 2, the calm line. 30 times your annual expenses, or roughly a 3.3% withdrawal rate. This is the number that actually changes the psychological experience. Here's why mathematically. A 30% market crash, and 3 such crashes have occurred in the last 25 years. In the dot-com bust in 2008, and during COVID, 1.9 reduces a portfolio held at 30 times expenses to roughly 21 times expenses. Your effective withdrawal rate on the original balance moves from 3.3% to 4.7%. That 4.7% is exactly what retirement researcher Bill Bengen now says some retirees can safely plan to withdraw, even in worst-case scenarios. In his updated 2025 research, you are at the edge, but you are not past it. The boat is rocking. You can see it rocking, but it is not sinking. More importantly, at 30 times expenses, you have roughly 6 to 12 months more of your portfolio to deploy as a cash buffer before you ever need to sell an equity during a downturn. That cash buffer changes the sequence of returns math entirely. You are not selling shares at a depressed price to pay rent. You are waiting. Waiting costs nothing. Every single historical drawdown was followed by a full recovery and new all-time highs. The 2020 crash recovered in just 5 months. The 2008 crash took about 4 years. The dot-com bust took about 7 years. Patience was rewarded in every case. Let me put the calm line into specific dollar terms. Annual spending of $50,000. The survival line is $1,250,000. The calm line is $1,500,000. You need $250,000 more dollars to cross from this market crash might ruin me to this market crash is kind of boring. Annual spending of $70,000. Survival line is $1,750,000. Calm line is $2,100,000. The gap is $350,000. At a reasonable savings rate and a low-cost index strategy, that might represent 2 to 4 additional years of work. 2 to 4 years of work, that is the price of sleeping through corrections. Annual spending of $100,000. Survival line is $2,500,000. Calm line is $3 million. Gap is $500,000. Steeper, but the same principle. Level 3, the indifference line. 40 times your annual expenses. A 2.5% withdrawal rate. The S&P 500 average 30-year return from January 1996 through December 2025 is 10.4%. Inflation adjusted, that's roughly 7% real. At a 2.5% withdrawal rate, your portfolio is withdrawing less than half its real long-run return. In most historical scenarios, your portfolio is growing faster than you're spending it. A 50% market crash, the worst single decline in modern history, would push your effective withdrawal rate to 5%. You are still within Bengen's new upper bound. You have room. The 3 worst bear markets in modern history were the 2008 financial crisis at negative 56.8% peak to trough, the dot-com bust of 2000 through 2002 at negative 49.1%, and the COVID-19 crash of 2020 at negative 33.9%. Even the absolute worst of these 2008 would not blow up a 40 times expenses portfolio at a 2.5% withdrawal rate. The math says you're fine, and eventually your brain agrees. You're on the ship. The storm is background noise. You order dessert. But here's the part that makes most people reconsider everything they think they know about getting there. The financial industry has a structural incentive to keep you from understanding the gap between these 3 levels. Not a conspiracy, just math and incentives. Let me show you a 1% advisory fee can reduce your portfolio's value by 28% over a 30-year period. For a $2 million portfolio earning 7% annually, that 1% fee could mean over $375,000 in lost wealth after 10 years, and more than $566,000 over 30 years. And as your portfolio grows, so does the dollar amount of the fee. Here's a cleaner version of that number. Consider a $1 million portfolio growing at 7% annually. Over 10 years, that could grow to about $1,967,000 if left untouched. Add a seemingly modest 1% annual advisory fee, and your ending value drops to roughly $1,779,000. That's a $188,000 difference in 10 years on 1 million. Now, run that math over a 30-year accumulation phase on a portfolio that starts at 400,000 and grows toward 2 million. At a 4% withdrawal rate in retirement, a 1% advisory fee represents 25% of your annual retirement spending. The fee accounts for $1 of every 4 you withdraw. Think about that framing. You worked 30 years, you saved, you compounded, you finally get to retire, and 1 out of every $4 you withdraw is going to someone who may or may not have added meaningful value to your financial life. Not to your rent, not to your groceries, to your advisor's fee. A 1% difference in fees can mean working 5 to 7 years longer before retirement. 5 to 7 years. Not invested badly, not caught in a crash, not unlucky, just paying standard industry fees. It's only 1%. That's the line you'll hear. That's the line advisors will tell you with a straight face while showing you a pie chart. It's the ocean boiling 1 degree at a time. Now I want to come back to the two brothers. David retired in late 2006 at age 55. He had saved $800,000. His annual expenses were $40,000. That put him at 20 times expenses below even the survival line. But he didn't know that framework existed. He figured he had enough cushion to work with market fluctuations. In 2008, the market fell by 38.49%. David's $800,000 became approximately $480,000, and he was still withdrawing $40,000 a year to live on. He was selling shares at the bottom. He watched his principal shrink in real time, while his living expenses stayed constant. By 2010, he went back to work. Not because the market failed him permanently. After the market crashed in 2008, it bounced back with a return of 23.45% in 2009 and continued to rise for 6 years. But because the sequence hit him at the exact wrong moment and his portfolio couldn't carry the withdrawal load through the trough, his brother Paul retired in early 2009. Same discipline, slightly different timing. Paul's $800,000 had become around $500,000 by the time he retired, actually less than David's starting number. But Paul retired into the first year of what would become one of the longest bull runs in market history. He never had to sell shares at a depressed price. His portfolio grew before he had to lean on it heavily. He is comfortable today. Same savings discipline, same portfolio size at peak, completely different outcomes, not because of investment skill, because of the calendar. This is the story that sequence of returns risk tells you. And it is the reason the calm line with its buffer, its lower withdrawal rate, its extra psychological headroom is not optional. It's the difference between David's story and Paul's. Now, let me give you the mini case study with specific numbers, because abstract frameworks are worth nothing if you can't translate them to your own situation. Marcus is 48 years old. He works in project management at a mid-sized company in Columbus, Ohio. He earns $95,000 a year. His household expenses run about $72,000 annually. Mortgage, 2 kids in high school, normal life. He has saved $390,000. According to the Federal Reserve's Survey of Consumer Finances, that puts Marcus well above the median for his age group. Americans in their 40s have a median retirement savings balance of $220,919. But Marcus doesn't feel ahead. He feels behind. Every market dip makes him check his phone. He told his wife after the correction in early 2025 that he was thinking about moving everything to bonds. Marcus's survival line, at 25 times $72,000, is $1,800,000. His calm line is $2,160,000. His indifference line is $2,880,000. He is $1,770,000 from the calm line. Here's what Marcus is currently doing that is actively working against him. He's paying a 1.1% advisory fee on his $390,000. That's $4,290 per year extracted from his compounding base. His advisor has him in moderately active mutual funds with an average expense ratio of about 0.5% combined fee load, 1.6% annually. A seemingly small 1% difference in annual fees can reduce your final portfolio value by 20 to 30% over 30 years. At 1.6% combined drag, Marcus is giving up something closer to 35% of his final portfolio value compared to a 0.1% index strategy. Run the compound math. Over 20 years, the difference between a 1.6% all-in fee and a 0.1% all-in fee on a growing portfolio could be $200,000 to $400,000, which at $72,000 a year in expenses is between 2.8 and 5.6 years of additional living expenses. Or, to say it differently, Marcus may be paying fees that are delaying his arrival at the comm line by 3 to 4 years. 3 to 4 years. Not a stock market crash. Not a black swan event. A quarterly fee statement nobody reads. If Marcus moved to a total market index fund strategy today, 0.07% expense ratio, no advisory fee, maintained his current savings rate, and simply did not panic sell during corrections, the math suggests he could reach the comm line roughly 3 years earlier. He doesn't need to get clever. He needs to get boring. This is the core mechanic of the whole thing. The boring portfolio beats the exciting one. Not occasionally, consistently. Over the last 10 years, the number of active managers outperforming the market is less than 7%. Less than 7% of professional money managers, whose entire job is to beat the index, actually beat the index over a decade. And they charge 1 to 2% for the privilege of probably underperforming. The retail investor who just holds a total market index fund and ignores his phone for market dips is statistically more likely to outperform 93% of professional managers over a 10-year window. That's not a small edge. That's the edge. That's the whole game. There's a reason most financial complexity exists, and it is not to help you. Complexity creates dependency. Dependency creates fees. Fees create the illusion that you need someone qualified to interpret the complexity for you. The circle is self-reinforcing and deeply profitable for everyone except the person whose retirement it's supposed to fund. An advisor once told a friend of mine, and this story is almost too perfect to be true, but it is, the market is very complicated right now. I wouldn't make any major moves. The market had been up 14% that year. It was not complicated. It was boring. Boringly up. The complication was invented to justify the relationship. Meanwhile, Marcus's 3-level framework gives him a cleaner mental model than any advisor conversation. Level 1, I can probably retire. Level 2, I can retire without stress. Level 3, I cannot remember what stress feels like. The question is not which level to aim for. The question is which level you can realistically reach given your timeline, savings rate, and fee structure. Now for the 3 practical takeaways specific to this video, calibrated to the math we just walked through. First, stop using 25 times expenses as your finish line. Recalculate your target as 30 times your current annual spending. If your annual spending is $60,000, your real number is $1 million. $800,000, not $1 million. $500,000. Add a buffer for taxes on withdrawals if your savings are in pre-tax accounts, which most 401k balances are. How much do you need to withdraw to receive your target income? If everything is in a Roth IRA, you may be fine. But for most people, there are tax consequences to their withdrawals, unless their needs are low enough to sit within the 0% tax bracket. If you're drawing from a traditional 401k, you may need to add 15 to 20% to your withdrawal to cover federal income tax, which means your actual spending target for 30 times math should reflect gross withdrawals, not net income. Second, do the fee audit today, not next quarter. Open a blank spreadsheet. Find the advisory fee percentage, if any, on your investable accounts. Find the expense ratios on every fund you hold. This is in every fund's prospectus and on any fund data website. Add them. If the combined number is above 0.5% per year, you are paying for something that decades of data suggest does not pay for itself. The math is not subtle. The historical average yearly return of the S&P 500 is 9.434% over the last 150 years. A 0.07% total market index fund keeps almost all of that. A 1.5% combined fee portfolio keeps roughly 8.5%. The real-world gap over 20 years on a $500,000 portfolio is in the hundreds of thousands of dollars. Not a rounding error, a retirement milestone. Third, build your sequence of returns buffer before you cross the finish line. 18 to 24 months of living expenses in cash or short-term treasuries separate from your equity portfolio, treated as untouchable except for living costs during a down market. This does not need to earn much. Its job is not return. Its job is to ensure you never have to sell equity shares during a bad year. Consider dividing your retirement savings into 3 buckets. The first, kept primarily in liquid assets with minimal exposure to market fluctuations, includes enough money to meet income needs for the first 3 to 5 years of retirement. At that point, the sequence of returns math changes. You are no longer forced to sell shares at depressed prices. You wait, the market recovers. The average time to recovery is 3 months from a 5 to 10% downturn and 8 months from a 10 to 20% correction. You are almost certainly fine within 2 years. And your equity portfolio participates in the recovery at full size, not the diminished size caused by forced selling. The fishing boat was always temporary. The only question was whether you knew that while you were building it. Lazy investing built more fortune than crypto memes. The investors who lost money permanently were almost exclusively those who sold during the downturn. Not the ones who held bad index funds. Not the ones who started too late. The ones who sold at the bottom because nothing in their financial framework told them the size of the vessel they were in. Now you know the vessel sizes. Now you know the 3 lines. Stop sailing across an ocean in a fishing boat and calling it enough. End of script.